Well, with this year flying by again and quickly coming to a close, today I wanted to highlight some tax planning strategies for you and your family that you might look at enacting and considering here before December 31st. A lot of these ideas have to happen by the strict calendar year end, and some might apply a little bit more so than others, depending on your age and your circumstances. But this is part of the regular business practice that we do here for clients on an ongoing basis. Today's an educational item, but I want to bring your attention to them nonetheless. And here we go. Okay, if you turn 71 this year, this simply means that you must convert your RSP to a RRIF or an income fund before the end of this year. And it's, again, a new account. It's a tax-free rollover of assets from your RSP, say, to a RRIF. But again, it is a new account, so you want to make sure that you do name an updated beneficiary, make sure that's all current. With a RRIF, you're going to be required starting next year to take out a certain minimum percentage of that account. That's going to be T4 income, must be claimed each year, and that minimum percentage is going to increase as you age. This is just really the government's strategy on making sure that all those years that you had tax deferral benefits inside the RSP, those assets are finally going to have to start being withdrawn in a measured way, but again, claiming some of that income as tax each year going forward. One way that we can help clients save tax is something through the pension income tax credit. For clients that are fortunate enough to have a workplace pension, the first $2,000 that you earn, which is eligible pension income, is earned tax-free. So that's a major benefit. But if you are not one that has a workplace pension, but you do have an RSP that you've saved up over the years, if you're age 65 and beyond, you're able to move $2,000 from your RSP through a RRIF to a non-registered investment account or to your bank account or even to your tax-free savings account, assuming you have some contribution room there. But the benefit here is that you're able to move that $2,000 out of the RRIF tax-free. And depending on your tax bracket, that can definitely save you hundreds of dollars each year going forward. Now, with this year being a bit of a challenge in the equity markets and bond markets for that matter, there's a thing that you should be aware of. It's through enacting a capital loss and some assets that may be held inside your non-registered investment account. And the benefit of doing this now is that you'd be able to use a loss on an investment and use that loss to offset any capital gains tax that would have been payable on any securities you might have also sold this year. But again, even more importantly, you're able to carry that loss back for 2 years, which is last year and 2020. So you're able to go back and reclaim any capital gains tax that you would have otherwise had to pay in prior years. If you have additional losses that you're able to carry forward, there's a thing called a carry forward rule where you're able to carry forward those losses indefinitely into the future. So if you have capital gains again going forward in future years, you're able to use that loss of this year really as a credit to help offset any tax payable that you may have to pay in future years. Just be wary and mindful of the superficial loss rule, which is a 30-day rule, which simply means that you're not able to sell a security today and buy the exact same security, say tomorrow, or within that 30-day period, because if you do, that will negate and cancel and void the capital loss that you just tried to enact. You need to be out of that security for 30 days. So if you sell a mutual fund, for instance, you can't buy that exact same mutual fund back within the 30 days. One thing you might consider, a lot of people would do, is to sell that mutual fund, buy a different mutual fund, or buy an exchange traded fund or a stock or something like that, just so that you're not out of the market. There's a few things to be aware of in the superficial loss rule, but we'd help clients through understanding that to make sure that we enact all of these strategies here appropriately. If you are contributing to your RSP, again, you still have the first 60 days of 2023 to make your contribution, which would go again towards 2022 to help reduce your tax payable. But if again you turn age 71 this year, again, you must convert your RSP to a RRIF. Just keep in mind, this is the last year that you're able to make that RSP contribution, and your deadline is December the 31st. If you have kids and you have an education savings plan set up for them, just a reminder that the annual contribution limit is $2,500 per child, which would give you that 20% annual government grant. But if you've not maximized that $2,500 per child per year going in the past, you are able to have a catch-up limit of $5,000 where you could put that $5,000 in to help reclaim prior years where you did not maximize. And again, you get the 20% grant on that full amount. There's an age 17 rule, which just simply means this is the last year that the child qualifies in order to earn that government grant, that 20%. So this is one of those key years where you want to make that contribution before the end of the calendar year. If you're charitable and making donations, the deadline, of course, December 31st, but I've mentioned here that you're able to gift securities to a charity from your non-registered investment account. I can help facilitate that with you. You would end up receiving the tax receipt, which is based on the fair market value of those securities that were donated. But again, the strategy here would be that if those securities have appreciated in value, you're able to, again, donate those shares to charity, but you avoid the capital gains that otherwise would have been paid if you just simply sold those shares and then donated the proceeds to the charity. You'd be wise to consider options where you could donate those securities that have appreciated because you would avoid those capital gains. Well, that's it for today, but I wanted to see if you had any questions. You're more than welcome to reach out, and happy to talk about this and anything else for that matter. Thanks for listening.